Hi guys, welcome back to my channel. This is your boy Alf. I'm back here with another video. I hope you guys are having a productive and fantastic week. Today what I want to talk about is basically how as an investor you can determine whether a company will continue to pay its dividend in the foreseeable future and therefore you should invest in it. Let's get into it. Now, as a starters, none of my videos constitute as financial advice. If you guys require a financial advisor, please contact someone who's registered and they'll be able to assist you. Now, in this video, I'm going to be talking about two metrics, basically free cash flow and your dividend payout ratio. I'm going to be focusing more on free cash flow because it's the meat of what we're going to be talking about today. Now, in the next session, I'm going to be diving into the actual numbers and showing you guys how I go about applying what we're going to be talking about today when I'm about to pick the stock that I'm about to invest in. So the number one reason I like investing in stocks is the dividend that you get is passive. All you do is pick the stock, the directors of the company steer the company in the right direction, and at the end of the year, you get a dividend payout from whatever the company has earned. Now let's get into free cash flow. Free cash flow is probably the most popular metric that analysts or investors will use because it shows how much money a company can give back to its shareholders. Generally, free cash flow is defined as operating cash flow minus any capital expenditure, such as any money that is spent on buying property, plant, and equipment. And this line item can be found directly on the cash flow for some entities. Some entities choose not to disclose it depending on their reporting requirements. But a simple calc is basically taking the cash generated from operations and you subtract any cash that is used to buy any property, plant, and equipment, or you add back any proceeds that are received from selling such property, plant, and equipment. Now, why is free cash flow very important? For starters, free cash flow is a very conservative metric than operating cash flow, given that it subtracts the cash that the company will need to go and spend for expansion on any PPE. Now, PPE are your revenue generating vehicles, and companies need to continue spending on PPE if they are to continue operating and generating an income. So after subtracting your PPE expenditure, you can have a clear picture on whether a company has enough cash to pay back to its shareholders. Secondly, free cash flow can determine the quality of earnings that the company has. There are perfectly legal ways out there to calculate the earnings of a company based on management's classification of certain items and how their revenue will be earned. But free cash flow is cash. You either received it or you did not. And cash is king. If earnings are backed by cash received, they are viewed as high quality earnings, whereas earnings that are not backed by cash are seen as low quality earnings. And lastly, which brings us to the question, how do you determine that the company will continue paying out its dividends in the foreseeable future? Free cash flow can be compared to a company's financial obligation to determine if those obligations can be met. Now, there may be cash on the balance sheet, but if your cash inflows are lower than your cash outflows, then the cash in the balance sheet will eventually run out. Now, the calculation is straightforward. To see if a company will continue paying you dividends, you need to take the free cash flow and you subtract it from the dividend cash outflow. If the result that you get is positive, it means that the dividends are sustainable. The greater the surplus, the stronger the margin of safety that the company has. There may be periods where the dividend cash outflow exceeds the free cash flow, and that's okay, as long as it's not on a recurring basis. And hence, what you want to do is compare this whole analysis over a period of around 5 to 10 years. Now, the second metric is dividend payout ratio. As I mentioned, many analysts will cite dividend payout ratio as an indicator of whether a dividend is sustainable. The formula is simple. Divide the dividend payout by the net profit of the company. If the results turns out to be more than 100%, meaning that the dividend payout is higher than the net profit of the company, the dividend is considered unsustainable. After all, you can't keep paying more than what you take in. I hope you guys enjoyed what we talked about today, and as I mentioned, in the next session, I'll be touching more on the practicality of how I go about doing this, and I'll be showing you the numbers that back what I'm talking about and ideally real life companies that one can look into. If you like the information that I just talked about, please like and subscribe and stay tuned for more.